account, correct?
I suppose so.
Yeah, there you go. I see it on there. Perfect.
Okay.
And so everyone, we have got a great, exciting call today, and a great pleasure of having the main analyst for FXB, which is Stefanos. Stefanos is going to take us through some live analysis today. He's going to share his screen. He doesn't have a camera, but he is going to share his screen and take us right through. So it's going to increase our understanding, increase your confidence, and this will also be recorded for those that weren't able to make it today. That would be we'll be able to send that to them. So as a reminder, everyone, regardless of who you are, please mute yourself out so that we can hear Stefanos. And Stefanos, over to you, my friend. Take it away.
All right. Just this question. Let me see. Okay, so I'm going to share my screen now. Yeah, can you guys see my screen now?
Perfect.
All right. Okay. So basically, this is how my screen looks whenever I'm trading with all the indicators set up. Now, what I'm going to do, basically, I'm going to open up a new chart, and then I'm going to start adding indicators one by one, and I'll be explaining which indicators I'm adding and what the indicators, basically, what information each indicator gives me. Okay. So once you open up a new chart, this is basically how it looks like. Now I'm just gonna adjust my colors a little bit so that I have a contrast of the bull candles, basically the candles going up and the candles going down. So my candles that are going up, I'm gonna keep them green. The candles that are going down, I'm gonna keep them, I'm gonna make them red so that it gives me a contrast between bull and bear candles. Now you can see it clearly. Basically, the candles that are going down are red in color, and the candles that are going up are green in color. I don't know how much understanding of the Forex markets you guys have, so I'm going to try and keep this as simple as possible so that you guys can actually follow. Now, Jeff, I don't know if you see any live questions coming from anybody from participating. So if you want to stop me at any time, please do. I would like to, stop and answer questions before moving on so that we don't get too many questions at the end.
Okay, great. Yes, I'll see the questions, and so periodically, if we have them come in, I'll let you know.
Excellent. Okay, so this is a basic chart of how any asset looks like. At the moment, we're looking at AUD USD. As you can see here on the left-hand side, I have the market watch, where all the available assets are there for me to choose on what I want to see. I have chosen randomly AUD USD today, and what I'm going to do is I'm going to start adding indicators in order to basically be able to do a technical analysis. Now, guys, technical analysis is a method, is one of the two methods that we have available to us in order to analyze the markets and make predictions whether the market will appreciate or depreciate in value. The reason why we're using technical indicators is to eliminate as much as possible the risk of making an investment in the markets. Now, the reason why we're using indicators is to get trading signals in the direction the market will take next. Okay, so what I'm going to do now, I'm going to start adding indicators on my chart. The first indicator I will add is the RSI. It's an abbreviation for Relative Strength Index, and it's an oscillator. Relative Strength Index, I'm adding it to my chart. Because it's an oscillator, it's depicted in a separate graphical window at the bottom of my graph chart. I'm not sure if you guys can see it clearly. Yeah? Okay, excellent. So as I said, this is RSI is an abbreviation for Relative Strength Index, and it shows me the relative strength of any asset that I'm analyzing. Now, as you can see here on the right-hand side, we have a vertical scale measuring from 0 to 100. There is two predetermined numbers there, the number 30 and the number 70 on the vertical scale. Now, these are very important numbers to us whenever we're doing an analysis, because the level 30 indicates an oversold asset, and usually whenever we have an asset which is oversold, the market tends to basically return to normal levels of trading. So what we can expect whenever the market hits the level 30 on the RSI is that we will have a movement to the opposite direction. As you can see, we have red candles here telling us that the market was moving downwards, the market was being sold, and then we reach this point down here. At this point down here, if you look at your RSI levels, you'll see that it corresponds to the level 30, telling me that the market is oversold, and more than likely the market is going to start moving in the opposite direction in order for the price levels in the market to normalize again. So that would, for me, would be one of the signals or indications for me to start thinking about opening a buy position once this level was reached. Like I said before, the reason why we're using indicators is to eliminate the risk of investing. So one single indicator does not provide me with enough confirmation in order to open up a trade. So what I'll do next is I'm going to add an additional indicator in order to strengthen that signal and to give me a better understanding of whether I should actually sell or buy this asset. Now, the indicator I'm adding is called zigzag. It's a very simple indicator, but very useful as well at the same time. What zigzag does for us, it basically indicates turning points in the market. As you can see, every time it connects, if it connects to the downside, it's telling me that the market is ready to reverse and start appreciating. When it connects to the top side, it tells me that the market has exhausted the buying positions, and the market will start reversing and depreciating again. So this is why they call it zigzag, because it connects to the lowest point, to the highest point, to the lowest point again, and so on. So basically, the way I'm using it is for an additional confirmation whether the market will actually reverse. So at this point that we've basically seen earlier, that I marked here as a point of reversal, I had a double confirmation. The first confirmation came from the RSI, which told me that on the level 30, as I said before, we know that it's considered to be oversold and the market is expected to reverse. And I had a second confirmation from the zigzag. Basically, I have two indicators telling me to buy there. Now, as we can see, the market started dropping again. So if we entered here, we can measure the movement to the upside that it basically done and see if that was actually a trade that we could have taken and be profitable on it. Now, this move made 19.7 pips. 19.7 pips with a one lot size position, for example, would have been $190. So definitely we had a little bit of room to place a trade there and actually make a profit.
Guys, everyone, please mute yourself, please. Thank you.
Are we clear so far? Any questions on the two indicators? No. Okay. All right. So what I'm gonna do is I'm gonna add another indicator, which is part of my setup. This indicator is also an oscillator. It's called stochastic oscillator. Being an oscillator, again, is depicted on a separate graphical window beneath my graph chart. Now, the oscillator works in a similar fashion as the RSI in terms that it gives me oversold and overbought levels. However, the oversold and overbought levels come at the level 20 on the stochastic oscillator, and the overbought comes at the level 80. So this tells me that when the market reaches the oversold at 20, there is the light.
Hey guys, somebody's got a lot of background noise. Get you to mute yourself out, please. And Stefanos, you may
Yeah.
be able to mute all in your upper right-hand corner, I think.
Give me a second. Let me see. Mute my audio. No.
Okay. Maybe we can go ahead. It's a little quieter now. Hopefully.
Yeah, sure.
I'll just remind everybody if it gets noisy again.
Yeah, no worries there. Yeah, as I was saying, we're on a stochastic oscillator. We have the oversold level at 20 and the overbought level at 80. So this is one of the two signals that come from the stochastic oscillator. As you can see here, whenever we reach the level 20, the market tends to shoot up and appreciate until we reach the level 80. This is definitely overbought over here because we have exceeded the level 80. And if I point my oscillator here, it's going to give me the value of the oscillator at this point, which was at 96. So this is definitely overbought. For me, would have definitely been a good entry to the downside. Now, as you can see, the market depreciated, came to the level 20 again, up again, down again, and so on. Now, this is one of the two signals that we can actually derive from the stochastic oscillator. The second confirmation comes whenever we have a crossing of the navy blue line over the dotted red line. This is a percentage D and a percentage K line. These are the moving averages. So whenever we have a crossing from top to bottom, this is another confirmation from the same indicator that the market will actually depreciate. And the opposite happens whenever we're on an oversold situation. If we see a crossing of the navy blue line over the red dotted line, it's an indication that the market will actually reverse and start moving to the upside. So let's see if we have a combination of the three indicators here. As you can see, we had a very steep drop. This is a trending market to the downside. We're looking at a 4-hour frame. So this basically is over a couple of weeks time. As you can see from here to here, let me mark the dates. So this was on the 17th of April, and here is the 25th of April. So this is basically over an 11-day period. We had a downtrend in the market. Now, obviously, whenever the market is trending downwards, we definitely want to be part of the trend. We don't want to go against the trend because we cannot influence the market to move in the direction that we want. And if we entered against the trend, more than likely we would have basically lost the trade. So having a look at these indicators, we got a first confirmation from the zigzag that the market is, the end is basically over and the market is looking to reverse. So one confirmation from the zigzag. We're looking at the RSI. We have a second confirmation for a buy because it's oversold below 30. We have another confirmation from the zigzag, from the stochastic oscillator, which is definitely showing an oversold level. And then we also have the crossing of the two lines, which is telling us to buy. So here would be a very good entry. We have 4 confirmations already. Now, there is another 2 indicators that I use. I'm going to go ahead and add them. The next indicator I'm going to add is a trend indicator. It's called Bollinger Bands. So these are the Bollinger Bands. Basically, what the Bollinger Bands attempt to do is to enclose the market within them. This is the top Bollinger, and this is the bottom Bollinger. So in a normal trading scenario, we see that the market is trading within the 2 Bollingers, the top Bollinger and the bottom Bollinger. Now, in a normal trading scenario, whenever we get a crossing of one of the Bollingers, either the bottom Bollinger or the top Bollinger, it's giving us a signal that the market has reached the lower levels of the normal trading, and it's time for the market to reverse and enter normal price levels. So here we have a confirmation from the Bollinger, that a signal from the Bollinger basically, that the market is going to move to the top side. And this is what happened here as well. And we had an additional confirmation from the zigzag, an additional confirmation from the stochastic. Now the RSI at that level was actually at 44. It wasn't completely oversold, but the market doesn't always need to be oversold for us to actually place a buy. An additional, some additional information that we receive from the Bollingers is whether the market will enter a trend or it's a simple, let's say, consolidation or whatnot. So whenever the market is entering a trend, we see that the Bollingers open up. Do you see how the Bollinger Bands are opening up here, like a bubble? It's telling me that the market is going to enter a trend. And because in a trend, the market is moving in high velocity, and here we have a downtrend, we cannot use the Bollingers anymore as a signal for reversal. Basically, you will see that the market will always be outside of the Bollingers because the market is moving in the lower extreme of the prices, and it remains there because we're having a strong downturn. But the important thing to keep is that when the Bollingers open up, it's telling us that the market is going to enter a trend. So if I had entered a selling position here where I have multiple confirmations, I wouldn't close my trade there where I would usually close it if I saw that the market is going to enter a trend. Because if the market is entering a trend, it tells me that I can make more money from the trade that I'm already in. I don't know if that makes sense to you guys, but these are technical analysis and technical aspects of the analysis.
That's actually very, very fascinating, Stefano. It's very educational. Guys, if you've got noise in your background, please mute your microphone. So, Stefano, I have a question for you.
Yeah.
So when you have, like we did over here in the right-hand portion, where you had two indicators that were signifying a move, and then you had one indicator that didn't necessarily confirm it. Do you make the trade, or how many indicators do you look for?
Certainly I look for at least 4 or 5 indicators to confirm the trade.
Yeah.
Otherwise, I will simply switch charts. As you can see here, I have multiple charts on my screen.
Mm-hmm.
I would simply switch charts and do an analysis on a different asset. Because, like I said before, one of the beautiful things about having a Forex account, it gives you the opportunity to diversify your portfolio with a single account. We have access to all the financial markets, including currency pairs, commodities, indices, stocks, cryptocurrencies, and so on. So there is no limit for me to limit my analysis on a single chart. I simply flip over to the next page, go to another asset, do an analysis again, and if I have a confirmation, then I will enter the trade.
Interesting. And you'll do a similar analysis across all the asset classes?
Yeah, of course. I mean, we work based on targets. We have a 1% target return on investment per day per account. So if I, let's say, start charting in the morning and I hit my 1% in an hour's time or 2 hours time or whatnot, then I simply basically stop trading. There's no reason to take additional risks in the market, because with every position that you open, you basically open yourself to the markets and you're taking an additional risk.
Mm-hmm. Mm-hmm.
Now, the assets we choose to analyze most of the times is also based on any fundamental news that are being released. This is a different method of analysis. I'm not gonna get into it today. I'm just gonna show you guys something so you understand what I'm saying.
Right.
Okay. So basically, this is an economic calendar that indicates all the upcoming announcements for the day. Okay, these announcements have already elapsed. The next announcement is the 10-year bond auction for the United States dollar. So what I will do before I start analyzing assets in the morning, I'll open my economic calendar, I'll see what announcements are expected on which currencies, and I start analyzing those currencies first because I expect volatility. This is macroeconomic data that are coming to us from statistical agencies around the world, basically statistical agencies from the country which is releasing the data. For example, the FOMC is coming from the Federal Reserve. Halifax in the UK is coming from the Halifax Bank of Scotland, and so on. Basically, these are solid macroeconomic data that we can use for analysis. I have sent an email with detailed examples and what do you call it, definitions of my indicators and the rules of entry. I made that public to you guys. You can share it with anybody you want. The theory of analysis and the practice are two totally different things. So I'm not scared of anybody stealing my strategy or whatnot. So there's no issues there if you guys want to share it.
Great. That's great. Alan has that. I'm sure he'll circulate that. This is first off, looking at this, it's made a lot of things clear to me. I've tried to study a little bit of technical analysis as well, Fibonacci levels and
right.
And everything.
Fibonacci levels, basically, we use them to measure what do you call it? Retracement levels. Okay. For example, we saw that the market had a downtrend all the way down here, and then we started getting buy signals from our indicators. Right now, when you enter, you definitely need to know when to exit as well in order to maximize your profitability. So Fibonacci is one of the tools that we use in order to estimate how deep the market will retrace. Okay, so I'm going to give you an example here. I've entered the Fibonacci retracement level, and I release it on the bottom, on the lowest low. Okay, and it starts giving me these lines. These lines are retracement levels. Okay, the first retracement level after a trend is 23.6% on the Fibonacci level, which is most of the times always reached. The next level is 38.2% on the Fibonacci, and as you can see, the market exactly retraced to that level and then dropped again. So this gives me an indication of how deep the retracement is going to be, and it gives me an understanding of where I need to exit. If I see that the market is pushing high and breaking above the 23.6, it means that it's going to reach the next level. So there is no reason for me to get out of the trade yet.
Fascinating.
Yeah.
Yeah, that's pretty amazing. And the Fibonacci, that's all based essentially on historical human behavior, right? I mean, that's
exactly. It's based on a theory derived from the famous Italian mathematician Fibonacci, and it actually works. It actually works.
Yeah. Well, this is exciting stuff, Stefanos, and I appreciate it, guys. We only have Stefanos for a few more minutes. If you have a question, go ahead and type it into the chat bar here. Now, Stefanos, did I read a text earlier today correctly that Alex will be on doing a screen share next week?
That is correct. He's going to do a separate session on his method of analysis, which is a little bit on the longer frame, and it's based on supply and demand imbalances.
Okay. And so the two of you basically analyze different asset classes at the same time, or take part of the portfolio and trade it within your disciplines?
Not necessarily separate assets. A long-term analysis can also be performed by me for a short-term entry, let's say. Okay. The difference between the two methods is Alex is more of a long-term trader. One of his trades can basically take 2 weeks or maybe 3 weeks. It depends for it to close, and obviously the targets are going to be much larger. I have a target of, let's say, on average between 15 to 30 pips per trade. His method of analysis allows him to go for 300 pips per trade. So ideally, Alex places, let's say, 4 to 5 trades a month. I place up to 20 trades a day.
Okay. Wow.
Yeah. My method is called high frequency trading. He's on the long-term trading, on the supply and demand levels.
Do you have a myfxbook.com account that we can follow FXB?
You have an FXB account for Omnia as well.
Okay, all right.
My FX book for Omnia. We set it up for you guys.
Okay, all right, great. So we'll publish that, or if anybody that wants to get that information, reach out and support.
Sure.
We can get that to you directly. Guys, we have way too much background noise, and I apologize. I'm not on a master account, so I can't mute everyone. However, we are coming to the end of our time here today, and Stephanie, I want to thank you for screen sharing analysis. Very educational. Guys, I hope that you all have gotten where we next week we're going to learn how to use the mute button as well, and I hope that everyone though has gotten a good learning session, but also a level of confidence that these guys know what they're doing, and this has been really exciting for me to watch. And so next week, guys, at the same time, we're going to have Alex Morrison with his kind of trading discipline and his expertise, showing how he sets up his trades. And so again, further education, inviting people on to the Zoom. We'll be circulating the link the day before or early this morning on Wednesday. And with that, everyone, Stefanos, thank you so much again for your time.
You're welcome, Jeff. It's always a pleasure.
Hello to Costas and to Alex for us.
Absolutely.
We look forward to seeing all of you guys next week.
Sounds good. Day, thank you again. Have a good evening.
Take care. Bye-bye.
Bye-bye.